Normal bank interest earned here in South Africa is entered under Code 4201. For taxpayers not yet 65, the first 23,800 of local interest earned is tax-free. For taxpayers 65 and older, the first 34,500 is tax-free. It is likely that these exemption amounts will remain unchanged in future, as in February 2015, SARS announced a retirement savings plan investment product with tax-free interest. This tax-free interest retirement savings plan does not replace the old Code 4201 bank interest investment. The Minister of Finance announced the introduction of this tax-free interest investment product to help stimulate saving in South Africa. The investment product is marketed by banks and financial institutions. These new retirement savings plan products are designed to assist citizens in saving for their retirement by offering tax-free returns. No CGT income implications, no dividends, just tax-free interest. It sounds great, but there is the fine print to consider. Contributions may not exceed 36,000 Rand in a year and no more than 500,000 Rand in a lifetime. Contributions exceeding these limits will be taxed at a straight 40%, and the tax will be recovered on your assessment. Now this is important. The interest is not taxed at 40%. The amount of contributions made in this year that exceed 36,000 Rand will be taxed at 40%. You are free to withdraw your money virtually whenever you want, and withdrawals are tax-free. It is important that tax practitioners know the tax implications involved here. Perhaps the fact that you can easily make withdrawals may mean that money in other retirement savings products could be preserved. The income screen in Wintax shows the taxpayer earned a salary of 600,000 Rand for the year and paid 146,709 Rand in pay-as-you-earn on the salary. If we click on this button here, it will open a window where we can enter taxable and tax-free local interest earned. Let's have a look at our taxpayer who had some interest income from different types of savings accounts. We can see that we have entered 24,000 of Code 4201 interest earned from an ordinary bank account such as a fixed deposit. Because our taxpayer is not yet 65, the first 23,800 Rand will be tax-free, and only 200 Rand of the 24,000 interest earned will be added to our income for tax. In this frame here, we can enter details of the new retirement savings plan with tax-free interest. In fact, we can use the Itemize button to enter the details of the bank accounts. You can see that we earned 900 Rand of tax-free interest from the 38,000 Rand we contributed to this retirement savings plan during the year. The program shows the excess of the 36,000 Rand contribution limit for the year taxed at 40% as per legislation. In this case, 40% of the 2,000 Rand excess contribution is 800 Rand, and this 800 Rand tax will be added to the tax due on normal taxable income in this tax year. If I drag the auto summary window over and show all the bottom line figures, we can see the 600,000 Rand salary plus a 200 Rand taxable portion of the ordinary bank interest makes 600,200 Rand income for tax. As we have no deductions, our taxable income is 600,200 Rand, and the tax tables show the tax on our taxable income to be 161,745 Rand. Add the 800 Rand tax due on the excess contributions we made this year to the retirement savings plan, and we see a tax amount due of 162,545 Rand. Note that the interest we earn from the retirement savings account is tax-free and not added to income. The 878 Rand shortfall on the taxes due is made up of the 800 Rand tax due on the excess contributions, plus the program has worked out that 78 Rand is due on the 200 Rand of Code 4201 ordinary bank interest that exceeds 23,800 Rand. Putting any money we may withdraw back into one of these new retirement savings plans could be a problem, as exceeding the 36,000 Rand contributions in a year means you will be taxed on the excess of 36,000 Rand at 40%. Don't see this as a bad thing. It's meant to convince you to keep your money in the investment. There's no such thing as a bad investment product out there. Each different investment product in the marketplace is designed for a different investor living under a different set of circumstances. Naturally, this retirement savings plan product with its tax-free interest has a place in many taxpayers' portfolios. Sure, it has its pros and cons, just like other products, each with their own different tax implications. Some of these retirement savings plans on offer may even have less ongoing fees or costs than a retirement fund, so the interest rate you receive should be pretty reasonable. Retirement plans like RAs, provident or pension funds may offer tax relief on contributions made when you make them, while the new retirement savings plan offers no tax relief on contributions made. The monthly benefits received from a retirement fund annuity are taxable, while any drawdown income received from one of these new retirement savings plans is completely tax-free. Having said all that, with tax thresholds as high as they are at the moment, there is little tax to be paid on modest annuity income anyway, unless it forms part of other income. If the invested capital is R1 million, for example, and the drawdown income is around 5% of capital, then the income would be about 50,000 Rand a year, and the tax threshold for taxpayers who are 65 and older is over 128,000. Each case must be treated individually when choosing an investment product, and you may need to seek help from a reputable financial advisor. Nevertheless, it is important for tax practitioners to know the tax implications relating to different investment products when asked for tax advice by taxpayers looking to invest. WinTax 2021 will use the new retirement fund tax laws to show you exactly what your maximum deduction claim allowed will be when investing in retirement funds.